Now let's get right to today's market action with Richard Bernstein of Richard Bernstein Advisors and Sameer Samana of Wells Fargo Investment Institute. Happy Monday, guys. Richard, you said at the end of July when you were with us the Fed need not be in a hurry to cut, and you predicted that at the end of the year, small and mid caps, emerging markets would look better than the bigs. You must be feeling pretty good.
Well, I'm not sure I'm feeling so good, but yes, I think the fundamentals are shifting. As I think we pointed out last time, that by the end of this year, early next year, earnings growth in both small and mid caps in the United States and emerging markets ex-China will actually be superior to the earnings growth of the Magnificent Seven. So, yeah, John, I think the fundamentals are coming home to roost, and I think the market is slowly, almost begrudgingly, trying to broaden here.
Now, Sameer, despite that, you're cautious and you still prefer large stocks over small, domestic over emerging markets. Why is that?
Yeah, I mean, look, I think some of the policies will probably get growth going in the U.S., but I think the tricky part's going to be is, and you can see it on the small cap side, so the Russell 2000, which is what we track, has actually seen its earnings estimates continue to fall all year. And it's fallen another, 5-10% just in the last month or so. So the tricky part is you're not seeing the economic growth trickle down from an earnings standpoint to the smaller caps. So we would stick with large caps. If you had to extend a little bit further down the market cap, we'd like mid caps. Small caps are neutral. There's probably some two-way risk there. And then the U.S. versus emerging markets trade is the cleanest one on the board. I mean, with what's going on in China, with what's going on with tariffs, we'll take the U.S. all day long over the international side.
Richard, we usually get these year-end rallies in presidential election years. Do you expect that we're going to get one, given everything that's factored in so far in 2024? And perhaps just as importantly, how does that set us up looking to next year?
Well, Morgan, there used to be what people called the January effect. And the January effect was when lower quality equities, lower quality bonds outperformed in January. And that seems to have moved more towards December in some recent years. So you see the junk bond market performing well in December, and you see small caps performing better in December. Could we see that again this year? Yeah, I think we probably could. I mean, if you think about the politics involved, there should be no greater group that benefits from the politics than domestically focused U.S. mid-cap and small-cap stocks. So maybe we will. Yeah.
Okay. And we are hearing increased conversation about American exceptionalism, U.S. exceptionalism, where the stock market is concerned. Sameer, it is interesting because, yes, the S&P, it looks like, finished today fractionally higher, but we've largely done a round trip in terms of the gains and then losses from right before the election to where we sit right now. And I'm going to ask you the same question that I asked Lori Calvasina on Friday, and that is if you are gaming out the impact of a new Trump administration coming in 2025, is this a stock market that feels more poised to be like 2016 or 2018?
Yeah, I mean, look, we are gaming it out. I mean, I think it'd be fair to say that, the red sweep was a little bit unexpected. We had modeled it out, and now we're kind of putting that playbook into play. And, what it looks like for us, and thankfully it kind of aligns with the macroeconomic environment, is we're most favorable on energy. We are favorable on U.S. over international. We like financials and industrials. I mentioned the last time I was on that if tech, let the leadership banner go, that financials and industrials would jump up and grab it. And then we like comm services. If you look at the sector, it trades at a market multiple with, about 1.5x the growth. We think that's a pretty good team on the field. What we've been saying is anything but defensives. We don't like utilities. We don't like staples. And we don't like emerging markets. In our opinion, that works both from a macro standpoint and from a policy standpoint.
Richard, investors at home are generally far more tilted toward stocks, toward equities than they have been historically. And that's worked out really, really well through this year as well. But what would you say to folks who feel like, well, fixed income, bonds, not really necessary, the rules of the game have sort of changed? Do you think that's true?
So I'm not quite sure, John. I think that, if you think about just the basics of investing, I'm sure most of your viewers have financial plans in one form or another. And that financial plan is used for two things. Number one, it's to protect investors from their own fear, right? Let's go back to the beginning of the bull market in 2009. Everybody's under their desk in the fetal position. Nobody wants equities. It's bonds, 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 income. That's all anybody wanted. And for many years, they missed out on the bull market. But the financial plan is also supposed to protect people from their own greed. And I think that's where we are right now, where people are taking an immense amount of risk if you look at private client equity beta, it's up to 1.45. I think you'd be very hard-pressed to find any pension endowment or foundation in the United States that runs an equity beta of 1.45. And they're overweighted in equities because now they believe it's the only game in town. So I think let's go back to the financial plan. Let's remember the financial plan is there to protect you from your fear, but it's also there to protect you from your greed.